even with the declines that we saw in the third quarter, the global equity market's having a very good year this year. But we're concerned going into the remainder of this year and into the beginning of 2024 that we can sustain this rally that we've seen. This rally has been very momentum driven, and actually it's been concentrated in just a select few stocks in the S&P 500. They're called the Magnificent Seven. Some of these stocks are, Amazon, Apple, Meta, Nvidia. These stocks are making up 85% of the total return that we've seen this year. That's just simply not sustainable, especially since some of these stocks have very elevated price to earnings multiples, which are challenged by higher interest rates. When you look at the S&P 500 as a whole, actually 50% of it is negative year to date through the third quarter. So this is a concentration risk that we think will pose ongoing challenges to the equity market. Also, for so long, we've been hearing the terminology TINA, meaning there is no alternative. And that's been because of the zero interest rate policy that has really been going on around the globe in the past decade, that there really is no alternative to equities but to buy equities. But we're seeing that change now. We're finally starting to see that bonds are offering some competition. When you look at this chart, this is looking at the 5-year earnings yield of the S&P 500 compared to the 5-year Treasury yield. And you're finally seeing that the 5-year Treasury yield is yielding more than the S&P 500 earnings yield. It's been the first time since 2002 that we've seen that. So bonds now are actually offering an alternative to equities. From an economic standpoint, we don't think that this rally is pricing in the risks that we've outlined. One of the things that we look at is the tight lending conditions from the banking sector. And you can see in this chart that typically when banks have to tighten lending conditions, it does put a kind of a stall into the economy, but also the equity market. You can see the blue line is when banks start to tighten lending conditions, and it typically does coincide with a pretty big pullback in the equity market. From an earnings perspective, we think that earnings are still way too high for next year in 2025. Most economists have pushed out the expectations for a recession from 2023 into 2024 or even 2025. But yet when you look at the earnings estimates for the S&P 500, they're between 10 and 15% for not only next year, but also 2025. So when we look at where we should be positioned in the equity market, we realize there are some opportunities from an international perspective where valuations look historically attractive compared to the US, but we are being very patient at this point. We think that the market is in for a correction in the fourth quarter or first half of 2024 as it reflects what we're expecting to be that higher for longer interest rate environment and a challenged economic outlook.